Uber Technologies is a very controversial company, and many people actually believe that it will cease to exist in the next 10 years because of robotaxis and self-driving vehicles. Now, as you can see, the company actually gets a strong buy rating from the Quant, a buy rating from Wall Street, and a buy rating from the SA Analysts. And what you probably didn't know is that the company themselves are working on their own self-driving technology. So jumping to my stock valuation spreadsheets, I have already plugged in Uber's ticker, and the first thing I want to point out is that currently they don't pay out any dividends. And I am actually in love with the fact that they don't pay out any dividends, as they can direct all of their free cash flow into innovation, which is exactly what they need to stay in the race of autonomous driving vehicles. Now, they are reporting their earnings on the 5th of February, so let's figure out if at their current trading price they would be considered a buy. Jumping to the 9-pillar analysis, they get a rating of only 3 out of 8, with most of the pillars actually sitting in the red. So let's pick all of this apart. The 5-year P/E ratio is sitting at -28, but if we zoom in closer to pillar 1, you can see that it actually jumped from -173 in 2022 to +77 in 2024, and currently it is sitting at 32.77. That is a huge accomplishment, jumping from -173 to +32. So investors are currently paying only $32.77 for $1 of Uber's earnings, and this is getting quite close to the average stock PE ratio. Now let's also have a look at Uber from the free cash flow perspective. So moving to pillar 2, that is the price to free cash flow over the past 5 years, you can see that that as well has moved from -92 in 2021 to +41.52, which it is sitting at currently. So a big accomplishment made by the company, moving from the negative sector to the positive sector. Now, as I always like to say on this channel, the stock price growth of a company is based on their financial growth, and as you can see, the only 3 pillars currently sitting in the red are the revenue growth, the free cash flow growth, and the net income growth. So let's have a look at these 3. Jumping to pillar 3, the revenue has grown from 11 billion in 2020 to 41 billion in 2024. That's a 400% increase in 5 years. That is phenomenal. Now, regarding the net income, that has increased from -6 billion in 2020 to +4.4 billion in 2024, actually increasing by more than 100% from 2023 to 2024. Again, that's a huge accomplishment. And finally, let's have a look at the free cash flow, which as well rose from the negative to +6 billion in 2024. Now, what you have to understand is that if Uber keeps growing at this rate, their PE ratio will dramatically decrease. Say that in 2025, their net income will grow by 50%, because from 2023, it grew by 100%, so 50% is quite a decent estimate. Jumping back to the stock screener, we can take the current trading price of the company of $66.85 and divide by the earnings per share of the company plus the 50%. So we will divide by 3, and that will give us a PE ratio of 22.28, which is very, very close to the average stock price PE ratio. It is actually in the range we would like it to be in. So if Uber keeps growing at the rate they are currently growing, they will in a very short period become fairly or even undervalued. Now, jumping back to the 9 pillars, let's have a look at some of the other metrics. You can see that the decreasing shares outstanding are sitting in the red. Uber has been increasing their shares outstanding at a rate of 4.17%, which I don't really mind, as they are a growing company and this helps them generate free cash flow, which they then push into innovation. So in this case, I don't mind them increasing their shares outstanding. We can also have a look at their 5-year profit margin, which is sitting at -15.35. But if I jump closer to pillar 6, actually, you can see that currently it is sitting at 10.49, and it again, like the net income, free cash flow, and revenue, has been increasing very steadily over the past 5 years. And not only has the profit margin been increasing, but the return on invested capital has been increasing as well. Look at this, I mean, increasing from -12% in 2020 to 6.51% in 2024. Now, one last thing I always like to look at when evaluating companies is their debt levels. If we have a look at the long-term liabilities over the 5-year free cash flow negative dividends, it is currently sitting at negative 3.75, but that is because Uber for most of the past 5 years had negative free cash flow. Now, jumping to pillar 9, we can see that they currently have about $20 billion in long-term liabilities. They don't pay out any dividends, so with the free cash flow they have generated in 2024, if they keep generating this amount of free cash flow, they can pay off all their long-term liabilities in about 3 years. So their $20 billion in long-term liabilities really doesn't bother me that much at all. So now that we have gone through the 9-pillar analysis, and you can see that Uber is a growing company, they have growing revenue, growing free cash flow, growing net income, growing profit margin, growing return on invested capital. They are a very fast growing company. Let's calculate their intrinsic value and figure out if at their current trading price they would be considered a buy. Now for the 5-year earnings growth estimate, I will plug in the high estimate at 25%, medium at 20% and low at 16%, and combining that with the analyst predictions, I will get a 5-year earnings growth estimate of 28.40% every single year over the next 5 years. I would then take the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $92.04, which is almost 30% higher than the current trading price. Now for the second valuation model, the discounted cash flow model, we will take the free cash flow of the company over the past 5 years and calculate an average growth rate of 152%. Now, as we are predicting into the next 8 years plus, into the long term, I will calculate a growth rate of only 8.3%. And by plugging that in and plugging in a discount rate at 9.2%, we will get an intrinsic value of $68.29, which is very close to the current trading price. Now for the multiples valuation, I want to compare Uber to 2 of its competitors. We will take these companies' current stock prices and divide by their negative earnings per share and get negative PE ratios. So if we actually multiply their negative PE ratios by the earnings per share of Uber, we will get a negative intrinsic value. So we won't use this valuation model, but I just wanted to show you that Uber compared to its competitors is doing really well. I mean, it has positive earnings per share, while its competitors both have negative earnings per share. So I will actually delete these 2 competitors and we will skip the multiples valuation model. And as Uber doesn't pay out any dividends either, we will also skip the dividend discount model and jump straight to the ultimate valuation. When we average out the 2 valuation models, we will get an intrinsic value of $80.17, which is almost 20% higher than the current trading price, and with a margin of safety of 15%, we would get an acceptable buy price at $68.14. Now, of course, don't invest into companies that the internet tells you to invest in. I'm here to teach you a process. So if you believe that Uber will go bankrupt in the next 5 years, don't invest into the company. But if you believe that they will become a thriving business, make sure to do more research and possibly invest into the company. And if you are certain that you invested well, your investment will return. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.